So you want your fortunes told? Gather round, my pretties, and we'll peer into the crystal ball. Spirits rise and spirits fall. Reveal your secrets. Tell us all.
Corey, we were talking about you trying to build a model to trade cryptocurrencies. And I thought this was a perfect timing or a perfect example of what it takes to actually build a model and all the nuances. So I guess let's start with, what was the general premise, and then where do you even start your process of building a model, a trading model?
Yeah, we've done a couple episodes now, sort of going down the degeneracy rabbit hole on different trades.
Ah, yes. You children are on a pleasure trip. But what's this? I see great danger as long as you stay in these mountains.
What I find very interesting about the crypto space in general is there's a very low barrier to entry. A lot of these centralized exchanges have APIs. As long as you meet their requirements as to what type of customer you can be, you can start messing around with different market making bots and all these other different types of strategies, arbitrage strategies, very easily, very low barrier to entry. And with all the data available and easy access to the exchanges, it makes it a very fun playground as a quant to start looking for certain types of anomalies. They don't exist easily in developed markets anymore. And you can actually find examples of those existing in real time on these cryptocurrency exchanges. And so that's been one of the areas that I've been exploring in my spare time to just sort of see how efficient are these markets.
And when you start off, do you think about what are the parameters for, as far as liquidity, bid-ask spreads? How do you even start conceiving of this is a good market for me to design a model to trade?
When approaching these markets, typically what I'm looking for is some sort of data anomaly.
Hello? Is anybody home?
The gypsy said the caretaker got scared away.
What a pad for ghosts. Well, we can't get in. Let's go home.
Wait a minute. Let's get out and look around first.
Right, I'm looking for an edge. And there's different classifications of edges. We could be looking for lead lag relationships across exchanges. We could be looking for arbitrage opportunities. We could just be looking for odd artifacts in the data that seem to be repeating. And so there's one trade that I've been making recently in my spare time that there does seem to be a persistent and predictable event that occurs, that it has a meaningful impact on cryptocurrency prices across all exchanges. To clarify what this trade looks like, I decided to record one such event in real time. In this case, I was expecting about $12 million in buy orders into Ethereum perpetuals to occur, so I bought some the minute before. The buy orders that I expected ended up pushing the market higher by about 37 basis points. And so it has created this situation where I can develop a model and say, I know this event is going to happen. I know it's going to happen at a certain time. I know exactly the amount that this party is likely to buy or sell. And I think it's going to have a certain impact on the market, which tells me what directional trade to make. Knowing all that on paper, though, is a lot easier than trying to implement it in practice.
See? Everything's all right.
Stop! You are not welcome in the castle. Go now, or abandon all hope of seeing the sun again.
You stop that. We have permission to visit this castle.
Go! This is your last warning.
Well, that's what I'm fascinated by is, in practice, theory never works, right? But it's hard enough to find the trade. So you find the trade, but then how do you go about coding up the trade? What are the steps and processes you go through, and how do you double check your work and make sure you don't miss anything, or any single step of that process can really affect that trade?
So the first step of the process for me was identifying this anomaly. And then in something where, some people will say, hey, look, I don't need to know the underlying reason something is occurring. I'm just going to trade it. I went the other route in this case and said, I really want to figure out why this event seems to keep happening. And so I was able to pinpoint exactly why I think this event is happening. And through a number of days of watching, be able to hone in and say, yep, I can predict prior to the event exactly what's going to happen for the most part, with a good degree of accuracy, which tells me I've sort of pinpointed exactly who the party is that's creating this market impact.
I've seen this before.
Look! Hey, look what Scooby found! Some pearls sewn in a piece of tapestry.
That's what Daphne's clue meant. The Franken jewels were sewn in the tapestry. But the ghost took it away.
But he left us this second clue. This earring resembles the one the gypsy fortune teller was wearing. I think we'd better pay her another visit.
Which gives me an idea as to how robust I think this trade is going to be. Do I think that this party is going to continue to keep making whatever trade this is, or do I think that they might step back? I've got good reason to think that they're going to persist. So we've sort of established okay, there does seem to be an anomaly. I've spoken to other people about it. Some mention that, yep, they actually think it's the same thing I do. And it does seem like it's going to structurally persist. Now it gets into the nitty gritty of the actual operations of trading this. And as you mentioned, that's where the rubber meets the road. We're not talking about, okay, I've identified an anomaly. It's just as easy as saying, send a market order to buy before and sell after. One of the things we have to consider, for example, is how much do I think I can make in this trade? This event that I see on the market tends to have a market impact anywhere between 50 and 100 basis points, which means that if you are a liquidity taker, prior to the event, so you're crossing the bid-ask spread prior and you're crossing the bid-ask spread after, you could be eating into 25 to 50% of your profit, depending upon the fee range that you're in on a given exchange. And so all of a sudden, very small considerations like that really start to matter when you're talking about how to enter and exit these types of trades.
Yeah, like how would you even code that up to know if you have to start chasing the market or not? How do you code up the taker side, maker taker different? I mean, that's a lot of logic that has to go into that.
I think probably the most difficult logic for this is the actual execution logic. And this is not something I deal with typically on my day-to-day. I work in my traditional, actual job when I'm not moonlighting in cryptocurrency. I work with execution professionals who have honed in on these algorithms. When I'm sitting there saying, for example, I want to start trying to provide liquidity in the 30 seconds before I think the trade's going to go off. Well, what that means is, let's say I want to buy, I'm going to enter a buy order right below or right near the best bid. And I'm hoping someone crosses the spread. But if the market's moving up, my offer is going to get worse and worse and worse in the order book. So at a certain point, I need to time out my order, say, oh, that didn't work, modify it, and move it back up closer. All right. And again, I can just keep chasing. The real race conditions start to happen when I say, I go to modify my order. And in between the time I modify my order and send that modification to the exchange, I actually get filled. So then the exchange says, nope, you've been filled. My internal system says, I've tried to modify my order. I don't think I've been filled. And now all of a sudden you have this latency between what's happening on your server versus what's happening on the exchange's server. And you need to keep those intact. Other considerations are, what happens if you're trying to buy 1,000 lots and you get partially filled? So you get partially filled as maybe a liquidity maker. And then all of a sudden the clock's ticking. Do you just decide to be a taker at the very last minute? These are sort of the things that, from an actual execution perspective, become incredibly nuanced in terms of trying to put this trade on in an automated fashion.
I'm surprised to see you again, my pretties. Did you enjoy your visit to the castle?
We might ask you the same question.
Me? I never go to the castle.
Look, Scooby's got the tapestry.
Give me that, you mutt!
Get him, Scooby!
So you talked about like some of the nuances to the trade, partial fills, latency, et cetera. And then so part of that issue is then it's like man plus machine. You code this up, you unleash it onto the markets, but you're not so certain. So you want to watch that trade. But now we're in 24/7 trading markets. Does that make it a little bit more difficult that you have to be all hours of the night or setting your alarm to wake up in the middle of the night just to make sure your trade's not going rogue on you?
Yeah, you definitely need to make sure you have a lot of risk parameters set up correctly. I've been testing this trade more or less by hand. It's not fully automated for me yet. I sort of know when the event is going to happen and can start running some code prior to it, and I can check in on throughout the day. And every time I do it, I am sort of hovering over the code to make sure it's executing appropriately. And I will tell you, 50% of the time so far in the last week, I've had a bug in my code that I've had to fix by hand. And that's bound to happen. I'm testing in real time here code that I'm writing at night in my spare time. There's
You don't
bound to
wake
be
up
some
and write
logic
perfect
errors.
code?
Yeah, there's bound to be some logic errors for sure. I think some of my finer points have been, I was setting trailing stops, but I was using the completely incorrect lot size. I was trying to measure the size of this event, but I was doing it on the wrong cryptocurrencies at one point. So for example, I thought this event would impact Bitcoin, but I was actually measuring the impact on Ethereum and then trading Bitcoin. So I've had all sorts of wonderful little bugs and errors that I think are bound to happen. But again, I think the fun thing here is you can do this in very small size, right? I can trade $20 at a time, and it really doesn't matter when I'm testing until I go into production, right? It just gives me very real market feedback rather than trying to simulate all these things.
Good work, Scooby!
Look, a police car!
The caretaker from the castle reported there was some trouble up here. Who is this on the ground?
It also reminds me of, I think about historically, we've seen like seasonality trades or whatever, and everybody starts to front run the trade. So then the timing moves back and we start running into this beauty pageant problem. Are you starting to see those effects where you need to almost keep front running before as people figure out the trade?
I get the sense in talking to different parties about this trade, some very large crypto hedge funds, that they are aware of this event, but it's too small for them to trade. I think you and I have talked about this idea in the past that there are trades that are growth trades and there are trades that are income trades. This is likely a trade that I could never put a significant amount of money behind. But if I can peel out $100 from this trade every night, that's a lot of money to put in your pocket as an individual.
When you've been watching the trade and you're trying to be on the maker side and the trade's running away from you right when it's about to happen, are you just losing your mind?
It's heartbreaking. It's heartbreaking. This trade doesn't happen that frequently. It happens at least once a day. So you're sitting there going, I've got my once a day shot, at least at this trade. And you look at the what could have been. You go, if I had just entered and taken liquidity, I would have been so much better off than chasing the market 20 bips trying to provide liquidity. Again, I think with this sort of trade, you do need to think long-term expectation on average. If I'm going to do this 365 times in a year, you can't look at every single day and say what could have been. You need to sort of do what's best on average. But it doesn't mean you shouldn't continue to refine your thinking and say, maybe I am just better taking liquidity at the exact right time rather than introducing this variance of trying to make liquidity.
Why, it's Big Bob Oakley, alias the actor. He's a master at disguises and wanted in 7 states.
That explains a lot. He's been haunting the castle to scare people away.
He was after the Franken jewels, which are woven into that tapestry.
Yes, and I'd have gotten away with it, too. If it wasn't for these blasted kids and their dog.
Now make sure you like, subscribe, and hit that notification bell so you never miss one of these amazing episodes.